Welcome, everybody. We've got Terry Judge on, CEO of Core Advisors, and he's going to kind of fill us in on what's going on with cost segregation studies. Terry, I've worked with you. I've referred you. You've been around for a long time. Everyone's been anticipating to hear what you're good at, and just kind of wanted to start and see how, it's such uh, a really micro profession. There's not a million people that are out there that are doing it, and just kind of wanted to find out how you figured out this is something that you wanted to do and how you got into it.
Yeah, well, hey guys, well, good to be back. I think John, you
Absolutely.
and I did something like this a while ago, but
Yeah.
so I fell into this thing by accident. To be totally transparent, I'm not a CPA by training, and it's not my background. But I was intrigued by it when I did find out about this. Somebody sent it to me. It might have been probably a CPA or some newsletter I was on, but that's how it all started. I'm like, I don't know why I thought this was so interesting. I mean, because again, I'm not a CPA by training. However, I was in the consulting world. I was advising, building owners, businesses owners, how to reduce costs within their energy spend, and that's kind of what I was doing. And I discovered this thing called cost segregation, and it was intriguing. And I called my personal CPA out of the gate and said, "Hey, is this, what is this? Tell me about this." And you know, he went on to tell me that it's viable. He just did he didn't do it himself. He didn't do it in house. He didn't offer this service. And then as I went down the lane, asking other CPA firms around town, I realized quickly that nobody was offering this, and it absolutely blew my mind. And it's probably one of the greatest tax strategies that exist in the U.S. tax code, and it's been over the years. Like I've been doing this since 2006. So you guys do the math. Hence the white beard and white hair and the whole deal. Um, it's been the gift that keeps on giving. It's survived both administrations, Democrat and Republican. And it is just a way to, you don't eliminate tax. This is not an aggressive tax strategy. It's just a way to defer tax, mitigate tax by accelerating depreciation essentially out of buildings. We can write buildings off usually within 1 to 5 years, and so, as opposed to waiting 39 years. So imagine that. Why would you let the IRS hold on to that money for 39 years when you can get it in your pocket in today's dollars by applying the concepts of cost segregation studies? And it is a very niche area of the tax code. It's been, there's over 300 court cases now that support cost seg. And when you hire a legitimate company, you're able to dissect from a forensic standpoint of the building. We break it down right down to the electrical jack. So every cost that makes up the purchase price or the construction cost of a property, we're able to go in there and write off hundreds of components that would normally depreciate over 39 or for commercial or 27 and a half years for multifamily. We're now able to write the building off much quicker, usually under 5 years, and we can compress or front load all that depreciation. But then you can take it against income. Okay, now you want me to pause there, or you want me to roll into the?
Well, I want you to pause for a second because I have a question. Because I
Sure,
always,
But I love your excitability about the topic.
I love it. I love it. I mean, every time we talk about it, what I find so fascinating, I just want to kind of dive into this. You call your CPA, you call all these other CPAs, and they say, "Oh, that's great, but we don't do it." And then I bet I'm going to make an assumption right now. If they didn't learn it in school, or where were all of the people to say, "Oh, here's an idea." Like, how did so many people miss it? And I'm a big fan, Terry, but how did Terry Judge be the only person? It seems like, or one of the only niche people say, "Hey, there's a business idea here," and all these other. It's kind of like It's similar but not similar. Like, it seems to me they don't teach enough about business in medical school or law school, right? They teach you how to be a doctor or a lawyer, but they don't teach you actually how to run a business. And that seems to continually be missed. So how did this get missed? And how do you, and you still seem to be in a niche space?
I think Terry showed up. I think Terry was there that day that they were talking about this, and nobody else came.
Nobody else paid attention.
Yeah, it's like one of those home auctions. You just hope that no one shows up, and you're the only one bidding. You can come in really low.
Right.
Right.
I think it's just there's. Yeah, go ahead.
Yeah, go ahead. No, you go.
Oh, so there's a three-prong approach. I mean, there's and this is the reason for CPAs not doing this. It's just so there's a lot of legalities, there's a lot of case law around cost segregation. Okay, so that's number one. You really have to understand the laws. There's been over 300 court cases, as I mentioned, memorandums, all these different IRS ruling changes, updates. There's a lot of layers when we get into the cost seg piece. Then you've got engineering, right? So my team, we have this, it's a unique background where legal, tax, and engineering. So we have to understand how the buildings are actually put together, what are the standards, what year the buildings were put together, materials. There's all these what's called permanency tests. And if you move something out of the building, how much damage does it cause, like in terms of flooring? It's called these permanency rules. So, and then there's depreciation, and there's the normal tax piece, which every CPA intimately understands. So the other two pieces of the three-legged stool, they don't that's not their wheelhouse. So therefore CPAs tend to stay far away from this type of a strategy. And I'm always trying to educate a lot of our CPA partners, like, hey, embrace this. This is nothing scary. This is a viable, ethical, moral tax strategy that's 100% legal that CPAs must know, right? They're going to lose clients if they don't embrace, they don't engage. So we partner with CPAs. Now, CPAs, they don't do this as a service because, again, what I just explained, they don't want the audit risk, right? So we take on the audit risk, and we write a 100-page report, and we break down to the electrical wiring behind the walls, and then we'll even cross-reference some of the case law that supports what we're doing, so it becomes an audit trail so everybody can sleep at night, because you don't want to mess with the IRS, right? But we all want to pay our fair share of taxes, but nobody wants to leave a tip. And so therefore, we go in. Do you like that?
That's a good one. I like that.
No tax on tips?
No
tax on tips, baby. So we'll get into that here in a second. But so this is a way, the tax code is really set up for real estate investors and or entrepreneurs that are looking to mitigate their taxes. Even if you're not a real estate professional, you can participate in this, and it's a great way to strategically, reduce your taxes. Because if you're a high net worth individual like Gunsberg, you're getting creamed. You're getting creamed in taxes. And if you don't have a tax strategy around it, you're just paying Uncle Sam, 40% of your income every month or every week. So this is what we do. This is what we teach. We work with CPAs and we work with clients on how to go about this the right way. We're not going to cover all this on this call because we can't do it. However, we offer education, training, free feasibility analysis on any property around the country. We'll put it into our system, and we'll actually show you how it works, why it works, and if you own a building, or a residential investment property, you can qualify. So we're talking around, our average engagement generates about $200,000 to $300,000 in tax savings. That's kind of our average. Sometimes it's in the millions of dollars, and sometimes it's in the tens of thousands. But again, why would you leave money on the table when you don't have to? And it's just being, understand what's available, what's in the tax code, and how this all works. So this thing has been in the tax code since the late 60s. And it's gone through all this evolution, and then this big beautiful bill just passed. Do you want me to dive into that, or do you want me to pause and
Well, I have a question.
hit the brakes?
When this, just kind of going back to the beginning part of it, like, it's so nuanced, right? You say this has been in the tax code since the 60s. There's more than one thing like this, right? Where like it didn't take hold, or people didn't start leveraging or utilizing it for a long period of time. How did you realize, or how did you start speaking to people in not your language, right? But like making them understand, like how did you get to that point where it was like, this makes some sense. Obviously, you know, I would imagine the beginning part of it is like, listen, let me just do an assessment. I'm going to assess it for, you know, X, you know, it's free. Let me come in, let me assess you, and then move on from here. But how did you like start getting people to actually start buying into this? Because I don't, you know, like it's been, you know, whatever. I've known you what, 15 years. Like you know, it wasn't like this was blowing up, right? Like, you know, at that point in time, it was like we started, you know, getting this out to people. So just kind of curious how that all.
Yeah, I think because you know, obviously, when you talk about an IRS tax, you know, something that's going to offset taxes or reduce
Right.
taxes forever, it's like no way, dude. Like, come on, this is going to get me audited. I'm going to go to jail. This is too good to be true. So we would like in the beginning. I'm like, ooh, man, am I going to really end up in jail or what? You know, is this too good to be true? You
Right,
know, but
right.
but before I started the company. You know, we obviously we did a ton of due diligence. I read a lot of the case law. I really, you know, I was working with a couple CPAs right out of the gate that knew about this, but didn't have the outlet. So they were looking for me to become that outlet, and then I started realizing that okay, if I can get this one particular CPA on board, that's going to create credibility. And then obviously more and more CPAs were coming on board and working with me and validating and educating. We started doing seminars, and we would, you know, I would basically send people the case law under, you know, section 1250. And, you know, I started, hey, like, don't take it from me. Like, this is what it actually, this is in the tax code. And nobody wanted to read the tax code. I mean, it's 70,000 pages of just nonsense.
Right.
Right. So you
Right.
just got to, and so, you know, 20 years later, we've had zero disallowances, you know, doing this, meaning that the IRS has never disallowed a deduction of any one of our clients. So we, you know, we offer audit defense, but and over time, like you said, Jeff, now it's becoming, you know, mainstream. I mean, if you're a real estate investor or you're a CPA that has real estate investor clients and you're not like or adding this into the tax plan, oh my God, like you should be fired
Yeah, you're
immediately.
missing the boat. Right. You're missing
You're
the
missing
boat.
the boat. And I get asked, and I hate to even bring this up, but you know, maybe it's a wake up call, but I get asked all the time, Terry, can you refer me to a new CPA? Because because there's number one, the CPA didn't bring this to them; they heard it through through somebody else or heard it from us, you know. And we're working directly now with the client. And then I say, hey, you know, I'd like to meet your CPA. Obviously, we want to bring the CPA in out of the gate, make sure we're all on the same page. You know, was this purchased with a 1031 exchange? We need to know that up front. And we also want to work with the CPA because they've already taken some depreciation. We want to know what they're doing, and maybe we can enhance it or educate them and bring them into the fold. And so I think over time now it's becoming, you know, obviously it's very widely accepted. There's competitors that have popped out of the woodwork over the last couple of years in our space. Some are good, some are terrible. And just like anything, though, you've got great CPAs that embrace this and are all over it and have added this into their practice, even though they don't do it as a service. They would, you know, use it and outsource it to a company like mine. But there's still, I'm blown away. I'm shocked and almost like still like, wow, is that we, there's people will buy a building and 6 months later, somebody will mention, "Oh, by the way, you know, did you do a cost seg yet, or have we done a cost seg, or has your CPA?" And they're like, "No, it's always an afterthought." So, you know, we always try to like be educating and helping the community understand what the hell this is and why it works and why it's legal and why it's smart, you know, smart tax planning. Um, and this is not aggressive. By the way, I'll just mention this: the IRS now looks at the cost segregation, you know, method is the more legitimate way to write a building off. There's only two ways to write a property off in our tax code. One is called the straight line method. That is the normal. If Jeff, you and I buy a building, our CPA is going to depreciate it over what's called the straight line method. They're going to take small deductions over the next 30 years. And then the other pathway is cost segregation, where we're just basically taking a different approach, where we come in from a forensic auditing standpoint, and we are going to break the building down into different chunks, different bite sizes, different components. And a lot of the interior of a property of a building can be written off now basically immediately. And then all the land improvements such as the parking lots, curbs, landscape, fencing, underground drainage, swimming pools, you name it, anything outside, basically qualifies to be written off. Instead of depreciating it over, a 27.5 year lifespan, we can now write it off in year one. And that's huge for a real estate investor, because you're essentially, let's say you've got $500,000 into the project. Well, your first year tax benefit might be, 500,000 or 700,000 or a million. Therefore, you're now like in a surplus. You're like, oh my God, I just put all this money into the property, but I'm getting all this money back in the form of tax savings. And then we can spread that out over the next 20 years. You have a 20-year carry forward. So whatever you can't use, it carries forward. And if you're a real estate person, you can use this depreciation and you can move it against other income. Let's say you have other properties producing income, you own other businesses producing income. All of this is considered active, and it goes and it offsets any other active income that's coming in. So it's not a 1-for-1 if you're a real estate professional.
Yeah.
Right? So if you're not a real estate professional, you still participate. You just can't move it around. It's just kind of whatever you have depreciation with that property, you have income with that property. It's still considered passive, and passive can only offset passive income, and that's usually from if you're a real estate investor just investing passively, it's still wonderful. You're not going to pay tax on the income from that building. You just can't spread it around. And there's other loopholes and strategies that are available for other folks that are looking for tax mitigation with short-term rentals. That's a whole nother podcast.
Yeah.
It's pretty impressive. It's called the short-term rental loophole. We train on it. For those listening, if you're a high net worth individual and you're like, hey, I'm listening to you, I don't totally get it, but it sounds like this could be a good strategy. There's other layers, like I mentioned. Feel free to reach out. Happy to see what you're doing. If I can guide you in any way, we'd be happy to do so.
Yeah, I think it's great. Yeah, I mean, this stuff requires somebody to pick up the phone and actually call you for curated and custom guidance for sure. So just having some technical difficulties. so wait.
he was making fun of me earlier.
Right. So we got about 2-3 minutes left, Terry. Here's a question I have. You started your business when? How many years ago?
I started my business in 2006.
2006, right. So, studies show that 24% of U.S. businesses fail within the first year. About a third make it more than 10. And really, the numbers are staggering as far as what it is to survive. I just celebrated my 10-year anniversary of starting my coaching company. And so
awesome.
Congratulations to you. And I know Jeff's been in business, I think 15 plus years. So somebody who is, starting a business right now, and or what advice you would give yourself the day you started your business of what you know now, what would that one piece of advice be?
Take care of your clients, overserve them, over communicate with them, and don't just be a robot selling something. Really try to build a relationship with them.
Yeah.
Learn about their pains, their weaknesses, their strengths. And once you know that, then you have the straight in shot of solving it and becoming a rock star for them. And my clients are, my goal, I think we do a fairly good job at retaining clients. They like working with our company, but I think customer service, relationships, they have relationships with my engineers. They have relationships. They have relationships with different people in my company. And I think that's the sticky part of it. Because we really care. We follow up. We reach out to them when there's nothing at stake. I'm not trying to make money. I'm just saying, how you doing? What's going on? What can we help you with? How do we serve? You're good at this, John. You're always giving. And I think that percolates. So just be an over giver.
Yeah.
And maybe sometimes give away things for free.
Yeah.
Give education advice before you ask for money. And you'll have a lifelong client. You'll have a client for life.
I agree with everything you just said. I'll add a couple things to that.
Yeah.
Make everybody feel like they're your only client. Be obsessive with follow-up. Always pick up the phone before you shoot an email. Return every call. One thing I do is, Terry, unless I'm sleeping, I return every call, text, email, same day. And that if people always say, well, what's going to beat AI? That's going to beat AI because personal one-on-one connection. Terry, tell people your phone number and where they can connect with you, or your
Yeah,
website.
so it's 248-210-4843 is my direct number, 248-210-4843. And you can also hit me up on the email. It's just my name, Terry Judge, at coreadvisors.net.
Awesome.
Coreadvisors.net.
And your website is coreadvisors.net?
Coreadvisors.net, correct.
Yeah. All right, good. Terry, sorry that Jeff had technical difficulties. We'll have to have you back and really maybe talk about some niche spaces that we can dive into as well.
Love to.
Maybe we'll do it with like somebody in real estate too, and we can walk through some live examples. And but I just want to say, I've watched you grow your business over the years. It's really impressive. You're out there, you're networking, you're doing all the fundamentals to grow the business. And I think a lot of times people ask, what's more important, talent or passion? But if you have both, then it really accelerates your business in a great way. You have that, Jeff has that. If I could speak about myself, I have that. So it really makes a big difference. So think community, think about what, not only where your talent sits, but what you love to do, figure it out and serve the customer. Terry, I appreciate it. We'll have you back again when Jeff's technology is back. Thanks,
John, congratulations on your all your success as well for 10 years, man. That's awesome.
Too,
great to connect.
Yes, you too. All right,
man.
Thanks,
See
everybody.
Bye-bye.